Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We've got a live show, of course, today, and our numbers at the bottom of the screen. If you have questions about your portfolio, if you have concerns about maybe the advice you're getting, and you want a direct, straightforward answer to any of your investment questions without the conflicts of interest from insurance salespeople, annuity brokers, stockbrokers, and Wall Street, call us right now. We want to get your question answered so you can make better decisions around your portfolio so it benefits you instead of the person trying to sell you that product of the month. Our number's on the bottom of the screen. We'll take your call. When you call that number, one of my studio producers will take your call and relay it to me. This way you don't have to actually go on TV. You still get your question answered, but you make sure that you call the number right now. I know we are expecting a lot of calls today. Our average show, we probably get about 8 to 10 calls with questions every show. We want to help you, so the first ones that line up, you get your question answered quickly. I want to talk a little bit about the overall economy and the investment markets. And I want to tell you, kind of start off with a quick story. Every week I do a live radio show throughout Southwest Florida. In fact, it's the biggest show probably on the financial topics that surround you pre-retirees and retirees and your portfolio. We keep getting an amazing amount of phone calls from our radio listeners, people that are just really just nervous, emotional, and just making bad investment decisions with their portfolio. We're also getting a record number of people who were sold annuities at free dinner seminars or free lunch seminars who didn't know what they bought. One of the things I want to stress to every one of my listeners today, before you put your hard-earned money on an investment product, make sure you understand what you're getting yourself into. The sad fact is, in excess of 90% of so-called advisors really are acting in a broker or sales capacity. They work under suitability, and their interest and their firm, unfortunately, is much different than yours. And I know what you're saying, the person's a nice guy, bought me a steak dinner, but you know what? That steak dinner is going to cost you a heck of a lot more than you realize if you sign on the dotted line on some of these products that these people push onto unsuspecting investors. I want to make sure before, again, that happens to you, you do a little homework, and better yet, you can call my firm for a consultation. We are a fee-only registered investment advisory firm, none of the conflicts of sales, pure investment management, and we have a legal obligation to work in our client's best interest as a fiduciary. I'm going to put our number at the bottom of the screen. Call my office right now for a consultation. You can also visit my website for more information about my firm and also to download our free reports, how to avoid one of the riskiest products there is, in my opinion, and one of the most detrimental, which are annuities that unfortunately are sold to seniors every single day who truly don't understand what they got into. A little bit about the market. We see basically, generally speaking, the U.S. economy is slowly getting better. I've talked about this all year. Unfortunately, what we're seeing on the other side of the fence is many investors who are not participating in this great wealth effect because they don't know what to do. They're nervous. Maybe they're making emotional decisions. I want to pull up a quick chart of the S&P 500, and you can clearly see we've had a couple small dips this year, around 5%. That's pretty commonplace. In fact, dips in any investment market happen often a dozen and a half, or 2 dozen times a year. Not just the stock market, but also the bond market. In fact, let me pull up this chart. I know a lot of our investors out there that listen to my show buy municipal bonds. Take a look at this chart. That chart looks like straight down, fell off a cliff. This is if you're a municipal bond investor or you own bonds in general, you're looking at muni bonds that have dropped between 5 and 10% in value year to date. 5 to 10% negative year to date. I've repeatedly warned my TV and radio listeners, review your bond portfolio. Buy and hold is not the way to go. Sometimes you need to sell some of your bonds or change your allocation of the type of bonds you own. Statistically speaking, I talked about anywhere from 12 to 24 times a year. Almost every investment sector, not just the stock market, has little peaks and valleys. Even the bond market, even gold and real estate, all investments truly can have fluctuation. What's interesting is if I look at the S&P year to date, it's up around 15%. If I look at the long-term treasury bond, it's down around 10 to 12%. If I look at municipal bonds, depending on the maturity level, they're down between 5 and 10%. So the bottom line is this. If the stock market is so risky, then why is it up 15% year to date? And bonds, which are perceived to be safe, are down 5 to 10% or more, depending what kind of bonds you own. I truly believe over the next 3 to 5 years, we're going to slowly see interest rates slowly tick up. As interest rates move up, investors who are in the wrong kind of bonds or bond mutual funds are going to either lose a lot of money or make 0% rates of return on their money as their principal slowly goes down. The other risk you have with bonds is inflation risk, and given current interest rates, most bond portfolios will not keep up with inflation after tax, which is only another point of misery for retirees. So again, before you overload your boat, or if you're already overloaded in bonds, I would seriously suggest you take a look at your portfolio and get a comprehensive review, and maybe buy a firm that works in your best interest, like Rezny Wealth Management. Again, our website's at the bottom of the screen, and so is our phone number. You can call that number right now. You can also go to my website and schedule a consultation. We've opened, by the way, a special program for smaller investors who don't quite meet our larger account minimums. We can still help you. We've just opened a special program to help this smaller investor. Go to my website right now, visit it, and sign up for a consultation. I want to go to my first call. Ed in Fort Lauderdale, what do you think of Security Benefit Life Income Rider for generating income? I'm 71 years old. 8% bonus seems like a good way to increase my income. I know there must be a negative. Ed, there's more negatives than you realize. Security Benefit Life is an equity index annuity. They have actually a couple different equity index annuities. Equity index annuities are probably the most lethal investment, as far as I'm concerned, against senior citizens, meaning the worst investment. These things are sold on unsupported claims of bonuses, returns, stock market returns without losses, and so on. Let me talk a little bit about Security Benefit Life, the income rider, and this is unfortunately what a lot of seniors are sold on. First off, you talked about the 8% bonus. Yes, you get an 8% bonus on the income bucket, not on your real money. So essentially what happens, Ed, if you put $100,000 in that product, they basically, on the income side bucket, the hypothetical bucket I call it, they add 8% or an additional $8,000. The only way you can get that $8,000 is if you actually, what we call, take the income rider for life. The problem is, if you actually do the math, and by the way, my firm has done the math on this, and there's other smart financial people like ourselves who have written reports about equity index annuities and Security Benefit Life. If you do that income for life option, essentially what it's going to do, it's going to take approximately, at your age 71, it'll take approximately 15 years, 15 years to get your own money back. So if you put $100,000 in, given the income rider options they pay you on an annual basis, it's going to take you 15 years to get your own money back. So that means that puts you at 86 years of age. If you live past 86, and the longer you live, at that point, if you keep getting paid that monthly benefit, what's going to happen is that's then return on your capital, not return of. So the bottom line is this. These products basically are very complex. The returns are going to be extremely low, and the problem is you're in these things locked in for life in essence. So at the end of the day, Ed, is this. You're going to put your money into one of these equity index annuities. That income rider often is going to take between 15 and 20 years for most of them we reviewed to get your own money back. Then at that point, if you live long enough, any excess monies actually return on your money. Realistically, returns on these products probably will be between 1 and 3% a year from our calculations, 3% being high side, probably between 1 and 3. So you're basically buying a long-term investment on a income rider that probably best case scenario, if you live long enough, might average 3% a year. What I would tell you is you can buy government treasuries today that are 10-year government bonds that are already paying about 3%. So the bottom line is this. You can buy a real investment that has liquidity like a government treasury, and have liquidity of your money and actually have a potential to make a better rate of return on your money without insanely locking your money up in an annuity product. Now that product's good for the person selling it, but unfortunately he probably didn't explain it to you how I'm explaining it to you. Equity index annuities, or these hybrid annuities as they are now called, are sold to unsuspecting seniors and investors who don't understand the complexities of these. And the problem is the agents that sell them probably don't understand it much more than you do, so they give you claims of these bonuses and these rates of return, which in reality are never going to come to fruition, and unfortunately you'll be locked in with high surrender penalties to get your own money. I'm going to take a short break. I'll be right back with your calls, your questions, and concerns after this. Hi, I'm Brian Rezny. If you're like many investors, you've lost a lot of your retirement assets due to poor investment management or being sold investments that are often better for that so-called advisor than you. Most so-called advisors are just salespeople or brokers for investments their firms represent. No real advice at all. If you're tired of bad investment advice and are ready for positive change for your retirement, call my firm for a consultation. Don't settle for bad investment advice. There is a difference. Call us today. Hello, we're back. We're talking about the economy, the investment markets. I talked quite a bit about bonds, and we just had a great call about equity index annuity. And again, one of the things that I want to stress about annuities, these things are highly complex, and they benefit the insurance company and the agent more than they're ever going to benefit you. I despise annuities. In fact, I wrote a free report. It's available on my website for free. If you go to reznywealth.com, go to the Investor Resource tab, and we've written a report, it was recently released, why annuities are dangerous to your retirement and your wealth. If you want to find out more facts about annuities and why you should avoid annuities, go to my website right now, reznywealth.com. Read that free report. You'll be glad you did, so you can be an informed, educated investor who doesn't and won't be taken to the woodshed with your retirement money. Thomas in Boca Raton, Florida. I have 50% of my 401k plan in my company stock, Exxon. What do you think? Thomas, the first thing I would do immediately tomorrow or tonight if you can, go online and change your allocation. Nobody should ever own more than 5% of any one individual stock. Even if you're in a 401k plan, never own more than 5% of your company stock. In fact, in a 401k plan specifically, I recommend not allocating any money to the company stock. Let me tell you why. First off, your retirement, all your benefits, and your job and security are tied in with that company. Why would you then tie up your other investment money in that company as well? Every company can have bad points and go out of business. I don't think Exxon's going out of business anytime soon, but could that stock drop 50% in value if something goes wrong with the company? We saw that happen with BP a couple years ago. At the end of the day, you're taking way too much risk. If you own individual stocks outside your 401k plan, same rule applies. Never own more than 5% of any one individual stock, because if that one individual stock goes bankrupt or the company screws up, it won't screw up your retirement and your whole portfolio. You need better diversification. You need to spread that money out inside that 401k plan, Ed, and not just in Exxon stock and not half of your money. Chris in Fort Myers, Florida. Is it time to sell my municipal bond funds? I have approximately 50% of my $700,000 portfolio in them. Chris, great question. We have been getting a lot of calls, not only in our office, but also new clients have hired my firm in the last month and a half to 2 months. They start opening their statements, and they're realizing their bond mutual funds have dropped 4, 5, 6, 7, 8, 9, 10%. We're starting to see that. I've repeatedly, again, warned investors the time to own too many bonds, and especially intermediate to long-term duration bonds or bond funds, is over. You're taking too much risk. I think the pain has only begun with interest rates slowly going up. Remember, when rates go up, bond values go down. What I would tell you is this: if you have half your money in municipal bond funds, you might want to look at each one of those funds, because again, some funds may be short-term duration, under 3 years. Others might be 5 or 10 or 15. What I would suggest is call my office. I'll put our number on the bottom of the screen. Call my office for a consultation. We've got an office in Naples and in Fort Myers. Call us, schedule a consultation, sit down with us. We'll review your portfolio. We'll see if we can't come up with some ideas. And we'll also talk about how we effectively manage our clients' money to control risk and provide income and growth within your retirement. Stanley from Marco Island. My financial planner purchased Nuveen NPT and Nuveen NPP for me about 3 months ago. They're about 5% of my portfolio, $35,000 each. They both have taken a big hit. What should I do? Great question, Stanley. First off, the two Nuveen funds you own are called closed-end mutual funds, and I'm extremely familiar with both of these funds. In fact, I probably have received about a dozen phone calls on those exact same funds over the last couple months. The problem with the funds you own is these are the worst kind of funds to own in a rising interest rate environment. First off, the average duration of bonds in those closed-end funds are around 8 to 9 years. The second worst, or probably the worst part of this, is both of those funds deploy a lot of leverage, meaning they borrow money to buy more bonds. So what that does is it actually magnifies the downside. My guess is since you bought those about 3 months ago, you have to be down between 12 and 15% in value in just 3 months. And the pain is going to get worse. If rates keep going up, those will keep going down in value. You have too long a maturity in both of those funds, and they are highly leveraged. Both of them average about a 40% leverage ratio. The broker who sold these to you should be put away, to be honest with you. He shouldn't be in the business because he clearly doesn't understand interest rates, and he clearly sold you something that wasn't appropriate in today's economic scenario. Again, I'd encourage you to call my office. Let's look at the rest of your portfolio and see what else we can help iron out for you so you don't make these decisions and be sold something that is totally inappropriate for today's economy. If you're like Stanley and you've got a question about your portfolio, I am taking your calls right now. Call the number on the screen, 239-417-4711. When you call that number, my studio producer will take your call and he'll relay it to me so I can answer it right here on the TV, and you can make sure and rest assured you'll get the right answer for all of your investment questions. I also want to encourage all of our radio listeners to visit my website, ReznyWealth.com. If you go to my website, you can sign up for our newsletter. It's free. It comes out every Monday by email. You can also download 2 free reports on my website: why annuities are dangerous to your retirement and your wealth, and how to avoid outliving your money during retirement. Both reports are easy, excellent reads, and if you are serious about your retirement and you want to make sure you do the right thing for your money and your family, go to Rezny Wealth right now. Download those reports. They are free. And I can guarantee you, you will get a great education from reading those, and you'll be able to make better decisions about your money and your portfolio. Sam from Coral Gables. What do you think about TIPS, T-I-P-S? I have about $50,000 in TIP. I bought it in 2012, and it's way down. I'm not sure what to do. Help. Sam, great question. Basically, TIPS are Treasury Inflation Protected Securities, TIPS. If you own the TIP, that's an ETF that basically buys Treasury Inflated Protected Securities. These, again, are on the wrong side. I'm guessing you bought these because there was a lot of talk about inflation or maybe inflation coming, and or you were buying these because of the higher yield that you were supposedly supposed to get. The thing that I want to stress about bonds and bond investors that are listening to me today, you don't look at the interest rate you're getting. You need to look at total return, and meaning the interest rate you get plus the gain or loss in the value of the portfolio. You add those together, and that's your total return. Like my last caller who was down 12 to 15%, sure, his dividend was 6%, but if he lost 15% of his principal value, his total return is what? Negative 9%. Like you, what's happening with the TIPS is these are long-term duration securities, treasuries, And the problem is we haven't had really much inflation, and there's not much in the horizon. So what's happening as rates go up, these bonds actually go down. I think you're at the beginning of the crest where interest rates and bonds are going to collide. I firmly believe bonds will continue to go lower over the next 3 to 5 years as long as the economy continues to improve and the Fed starts to wane their tapering of bond buying, which is going to push up rates slowly, and it's going to hurt fixed income investors who ran for the safety of bonds, not understanding that they are one of your riskiest assets, in our opinion at my firm, for retirees right now. I'm going to take a short break. I'll be right back with your calls, your questions, and your concerns. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Do you know the biggest risk to your retirement and investments? One is entrusting your hard-earned money to someone who doesn't work in your best interest. The other is a lack of a detailed investment strategy to meet your goals. Both risks can be devastating, but both can be corrected. Rezny Wealth Management, fee-only money management. Don't settle for questionable investment advice. Call my firm for a consultation. There is a difference. And we're back. I've got time for about 4 or 5 more calls and questions. So if you call that number on the bottom of the screen, we'll make sure that you get your question answered. Let's start right up with our next caller. Thomas in Naples, Florida. I allowed a financial advisor from MetLife to convince me to put all my IRA into an annuity with a minimum income benefit rider of 5%. Selling it as a means of generating, guaranteeing my principal and a 5% income annually. Well, 4 years later, this has proven to be a grave mistake. What can I do? Thomas, I can't tell you how many calls I get on not only my TV but radio show about unhappy people who were sold an annuity. The first thing I would tell you is go to my website, read the free report. It's in our investor resource tab. Why annuities are dangerous to your retirement and your wealth. Read the report, and I urge all of our TV listeners today to download that report for free. The number one call in all of my TV and radio shows is about unhappy people who were sold annuities. Didn't understand them, realized once they got into them that these things were nothing like the person explained. Once they realized the internal high cost structure of fees, the complexities, the low rates of return, the lockup periods often as long as 22 years with big back-end surrenders to get your own money, they would go running for the door. The problem that you have, Thomas, is if you bought this 4 years ago, there's a good likelihood you still have a surrender penalty. So what I'm going to tell you is this. You really need to look at this specific annuity. You need to take a look at what the surrender penalty is going to be, what are the benefits that are actually going to be paid in the future, and it needs to be analyzed to see what's the net present value of those payments. Meaning, does it make sense to get rid of this annuity now and move to greener pastures, or are you kind of stuck in this? I would say it could be a 50-50 split. A lot of the people that come to my firm, depending on the annuity they bought and how the lockup is and the penalties, sometimes we can help them get out of these without being hurt too bad. At the end of the day, if you buy a long-term investment with low rates of return and high fees, it's going to hurt your return, and that's ultimately, in our opinion, going to hurt your retirement. I know you bought this for an income rider, and we had a call earlier about the same scenario. These income riders really don't have any ground to stand on. At the end of the day, if you really did an analysis on these income riders, it's a great way to sell emotional investors a benefit that will take often 15 to 20 years to get your own money back before you've even made a return on your money. I'm not sure who, if they really understood that, would buy one of these products. The problem is the annuity salesperson usually doesn't explain it the way that it should be explained, so you can make an informed decision. If it was explained properly, I could pretty much guarantee most people would run for the exit and never sign the check to buy one of these annuity products. Williams in Naples, Florida. Are rising rates a reason to sell all bond funds? No. Depends what kind of bonds or bond funds you own. As an example, clients of Rezny Wealth Management, we own primarily floating rate securities in either the ETF or the mutual fund format. Those are appropriate today because they're the shortest term duration. They're typically 90-day paper or less. They actually benefit from rising interest rates. So without knowing what kind of bond funds you own or the maturity level or the kind of bonds in those funds, it's hard to say, yeah, you should sell them all. What I would like to have you do is, if you do call back, give us an idea of one of the funds you own, and I give you specifics on that. One of the biggest funds out there in asset size is the PIMCO Total Return Fund. A lot of investors are invested in that fund, and that fund is definitely a sell in our criteria because not only the duration, but the size of the fund makes it less nimble and less opportunistic to get interest and income given today's investment horizon. So if you own that fund, that would definitely be one I would look at selling and replacing it with something like a floating rate type bond fund that can move up in value and interest rate as rates move up and is not subject to the increase in interest rates on the downside. Robert in Marco Island, Florida. What do you think about investing in China FXI? Great question. We own emerging markets at Rezny Wealth Management right now. In fact, we added those a few days ago. Emerging markets have been one of the weakest sectors year to date in almost all the markets overall. China was a great example. Right now, China is one of the stronger relative strengths. Remember, our strategy is we own relatively strong assets going up, and that's how we pick them, and we sell assets that are starting to top and get relatively weak. I like China right now. Again, positions can change at any time. We own China through the VWO through Vanguard, which is the Vanguard Emerging Market. So there are positions in China there, so I want to make that full disclosure. But I do like China. I like what's going on in their economic scenario. Their economy is starting to turn a little bit, and I firmly believe we've had a huge sell-off in China this year. The U.S. is here. I think some of the best opportunity gains as we get towards that last quarter of this year is probably going to be emerging markets. And by the way, emerging markets are now surpassing large cap S&P as relatively stronger. We own emerging markets. We like where it's positioned, and I firmly believe there could be great opportunity for the rest of this year. But we'll keep you in tune as we do our live shows every single Wednesday evening. I'm just about out of time. If your question wasn't answered, I apologize. We only have so much time on our Wednesdays. If you missed any part of this program, we're going to replay it this Sunday. Visit my website. It's at the bottom of the screen, reznywealth.com. I know we're getting a lot of calls about my firm and our services. We have offices in Naples and Fort Myers. Call us for a consultation. If you're tired of bad investment advice, you want to work with a real money management firm who works in a fiduciary capacity and a fee-only firm, call my firm for a consultation. There is a difference. We invite you to experience it. Until next Wednesday, have a great day.